Howdy there, folks. Welcome into the buy one, get two free. 3 videos for me to react to in this one here today, okay? First, we're going to react to this little quickie. Raise cash for upcoming market correction by trimming tech now. We'll speak about that subject. I want to give my opinion on selling positions to kind of raise cash. Second video we're going to react to is this one here. We're looking for a recession the second half of 2023. I want to react to that little 2-minute clip. And then lastly, I don't know if you guys heard about this today, but D.H. Horton stock spiked in a massive way, and then it sank in a massive way. Something very strange happened today with the home builder stocks, and so I want to react to this one, talk about that. I think this went way under the radar, and there's something fishy happened, okay? We'll just put it like that. So hope you guys enjoyed today's video. As always, I appreciate everybody joining me. Thanks so much for being subscribed. We are now at nearly 31,000 subscribers on the channel, a new all-time high. So I appreciate every single person that's here and enjoys the channel with me each and every day. Also, thank you everybody that supports on Patreon. If you'd like to join my Patreon and help support my content, then do so with the pinned comment down there. You get access to see all the moves I'm making, which tomorrow, literally, I'm buying stocks in the Patreon portfolio, so make sure you're in there to see what I'm up to, the moves I'm making in the market. You get to see the portfolio and each and every week, and on top of that, you get to be part of the Discord chat. So yeah, I would definitely take advantage of that ASAP. That will be pinned comment down there. Alrighty, guys, let's get into it.
His top 5 holdings of Apple, Microsoft, Nvidia, Tesla by 10% each, and that's in the final hour of trading yesterday. Do tell.
Yeah, and Adobe as well. I mean, these positions, echoing what Josh had said, they have just become so large within a portfolio. I mean, I've trimmed Nvidia multiple times this year, even to move it back to basically number 10, and it keeps elevating higher as the market moves. Now, this is what...
So the unfortunate thing is this man's been selling his Nvidia shares. Obviously, not a good move. like clearly he would have rather just held all the way through, right? This is why to try to time in and out of great companies, especially Nvidia is a great company, like to try to time in and out of that is usually a bad game.
I'm looking at the Fed meeting next week. We're looking at seasonality that's taken place from the end of June through the end of July. And I'm not going to just kind of raise a ton of cash all at once. So taking 10% off of each of those top 5 names here is starting to plan. I'll probably do a little bit more maybe before the Fed meeting next week. But by the end of this month, I hope to raise, and again, echoing what Jim had said, about 7% cash here going into what could be a more, just a correction that we could.
Okay, so first off, he's making a bad choice, okay? The reasoning he's making a huge, monumental mistake here is this man is talking about timing the market, right? This meeting, this and that, right? He's been selling Nvidia. And people have been doing this a whole year. Nvidia hit 125, people were selling. Nvidia hit 150, people were selling. Nvidia hit 200, people were selling. 250, they were selling. 300, they were selling. 350, they were selling. 400, they were selling. 450, they were selling. They're still selling, right? And so you're selling off a stock to try to time in and out, hoping it goes down. And here's the dilemma this creates. Now this same man has to buy shares back in. So now he is basically counting on the market to go substantially lower, so he can hopefully buy his positions at a much lower price than where he was sold at. So where's his average sell for Nvidia been this year? Maybe something in the 200. So now he needs Nvidia to go, what, to $300, maybe under $300, just to get that stock at what he was selling at earlier in the year? It's a flawed way of thinking. Well, now there is one good thing when it comes to kind of selling and building cash a little bit, and we'll speak about that in just a moment. But his overall thinking process about, well, this meeting, this and that, okay, this whole time in the market game, it's for the birds.
I was on the show last week and was talking about a correction that should happen between August and October. And I've been extremely bullish. It doesn't change that I'm very bullish, but you got to be realistic, and you got to say, okay, it could cool off a little bit. In seasonality, between August and October, it happens. Now, if it happens in August, I think it could be a 5% correction. If it happens really in October, we could be at record highs and it could be more of a 10% correction. And I plan on just raising cash through that. But these names have done terrific. I expect them to continue to do well. But it's a position management at this point.
You brought us full circle in a way from where we started the show, this growth versus value conversation, and taking some profits in growth and going towards perceived value anyway. You bought Amgen, which is a new position for you.
Yeah, we added Amgen. Now, we're looking at this as a nice accumulation. It's been since the that sell-off in May and some of the FTC news.
So selling, stocks like Nvidia and the creme de la creme stocks for a stock like Amgen. No disrespect to Amgen, no disrespect to any other stocks in the stock market, but you just got to understand you're trading out of the highest quality for less quality. There's no more quality than a stock like Nvidia. Like, that is the creme de la creme, right? There's no more quality than a stock like Meta. Like, stocks like that are what I call tier A plus. Okay, and so anytime you sell out of those to put the money somewhere else, you just got to understand, and you got to have to come to the realization that you are buying less quality. It doesn't mean it's necessarily a bad move for the next week or next month. You just got to admit what you're doing.
News that's going to develop with FTC, but I want more exposure in the healthcare space. We have AbbVie right outside the top 5. So I wanted to add something to diversify a bit more within the pharmaceutical space. And I really think that in the second half of this year, we're not going to see another 40% from tech. So where's the outperformance going to come from? I think it come from healthcare. I think it come from small caps. So I want to make sure I'm positioned properly over the next couple of months to be ready for that for the second half of the year.
I appreciate you joining us to go through that, Bill Baruch. We'll see you back here on the set.
So where does it make sense to trim positions and build cash? Okay, I'll tell you exactly when that makes sense. If you have no hedges in the market, so if you are not basically in a position where if the market goes down substantially, you can capitalize on that. And if they're in a position where you have no cash around, then it can make sense to sell out of some stocks to build some cash, right? Or sell some sort of position so you can build some cash. That's the one moment that makes cash. But if you're hedged in the market, if you're in a position where you're always able to buy each and every week, right? Because you're always in a position where you have more income than expenses, then it doesn't usually make sense, especially when you're selling some of these extremely high quality companies that have incredible long-term futures in front of them, right? So yeah, I just think that's a very important subject, okay? Next up here, we're looking for a recession second half of the 2023. Let's get into this one.
Guests saying that the markets are indeed in a melt-up mode and that investors are getting ahead of themselves. We want to bring in Megan Horniman, who is Chief Investment Officer at Verdance Capital Advisors. Megan, you think we're in a melt-up? You think we're in the middle of this? You think it continues?
I think it could continue a little bit until you get some more clarity out of the Federal Reserve. But this is a concerning rally that we've seen. It's been very concentrated. It's basically pricing in perfection from the earnings standpoint. You can see that today with the decline after some disappointments yesterday. We're not buying into this rally. We're more concerned that the economic outlook isn't being reflected.
Okay, so she's basically just said Tesla and Netflix selling off is, on the disappointments yesterday. Let's be very clear. Netflix did not disappoint yesterday. Tesla did not disappoint. Tesla beat revenues, they beat EPS, and they beat margins. Now you can say maybe they were priced to perfection going into earnings, so it didn't matter what they reported. That's fair. That's a fair debate. But to say they were disappointments, Netflix beat by almost 4 million subscribers? Like, that's not a disappointment. Netflix beat substantially in EPS. That's not a disappointment. So Netflix and Tesla earnings were both very good. You cannot call those disappointments when you're crushing what analysts were expecting.
The current prices, and we're a little bit more cautious here.
What concerns you? What's the downside risk scenario that you're thinking about?
So we still think that a recession is likely, and that we think investors got a little too optimistic that we can have this perfect soft landing scenario. So we're concerned from the economic standpoint in the second half of this year. Remember the tightening lending conditions and then the tight monetary policy, that always acts on a lag. And typically you see recessions do occur after that. So we're looking for a recession in the second half of this year going into 2024. We don't think the market's reflecting that economic downside. We also don't think the market's reflecting what the Fed may do. I think what you're seeing in the recent rally in risk assets is actually going to...
So what is she talking about here? Because now she just contradicted herself. She's basically saying there's a rally just in 7 stocks, or the biggest stocks, right? A few of the top dog stocks. But then she goes on to say the market's getting too optimistic. Okay, well, what's the market done? You just said we got some concentrated rally and, the rest of the market's lagging here majorly. Well, is the market really pricing in no recession? Think about that for a moment. Like, wait a minute. Like, are we really pricing in a scenario where we don't have a recession when all these other stocks are doing bad and it's just a concentrated dealio at the top, right? Important subject to keep in mind. And remember this, okay? Flip a flapjack. Remember this. Are these stocks even at all-time highs? Many of these stocks are still not even at all-time highs, right? Tesla's still way off of all-time highs. Of 2021 highs, right? When they were actually doing way less revenue than what they're doing today, right? Meta's obviously increased their business, and they're looking really, really good for the next few years. Meta's still not even close to their all-time high yet. You got a lot of stocks out there. Amazon, same exact situation. Amazon's got a business way built up from where it was a couple years ago when the stock was dramatically higher than where it is right now. Their revenues have built out. They're positioned so much better for the next several years than where they were a couple years ago. That stock's not even close to an all-time high. So there's a lot of these big dog stocks that have been doing tremendous that honestly still aren't even back to all-time highs. Like that's some food for thought there. And then we got a lot of stocks that have been lagging in the dividend category and the value stock categories. A lot of opportunities out there.
The Federal Reserve next week. And I think the market's not pricing in the chance that they can come in with a pretty hawkish hike next week.
Meaning they hike and then
they could, because they are clueless. We do know that. I mean, my gosh, how bad they screwed up the first go around. Now they're going to screw up this side. Trueflation has us at 2.1% CPI right now. Like, it wouldn't surprise me with how clueless the Fed is. I mean, it's incredible. It's almost like if you had the people to do the worst job possible, like it cracks me up. The fact that they are not considering cutting now. They need to be considering cutting. Inflation has gone down constantly. And you have more worries about deflation than inflation. This is what some of the most important CEOs in the world are talking about, as in like Elon Musk, as listened to the CEO of Amazon, talking about deflation in their latest conference calls, in their latest investor presentations, in their latest interviews, talking about several categories in deflation, right? But, the Fed's going to do whatever they're going to do.
Say a lot of things that lead people to think that there's another hike behind that.
Mm-hmm. Yeah, and I think they're walking a very fine line where they've done a lot of work on inflation. It's starting to do what they wanted to do, but again...
Starting to do what they want to do. For a year straight, inflation's been dropping. For a year straight. It hasn't started, okay? CPI came in at 3, government number. We know that lags. Right now we're in the 2s. Guess where they want CPI to be? 2s. So this is no starting. We're like closer to the finish line than the beginning of the race. I can tell you that.
This rally in risk assets, that can cause some of the work they've done to be unwound in the second half of this year. So they have to be very careful with how they articulate that next Fed hike.
You are still very heavily overweighted in cash at this point. Mm-hmm. Is that true?
Yeah, we do have a nice positioning, with dry powder so that we can put to work, because we do think that there's a decent correction headed our way in the second half of this year in the market. We think there'll be better.
This is exactly why we have had so much trouble having a massive sell-off in the market this year. Because of people like this, right? Men and women like this. These folks, we got all this cash on the sideline. We think there's going to be a correction. We think there's going to be a da-da-da. And it just hasn't happened. And month after month, the market ends up marching higher, and these stocks march higher, and they're still waiting, and they're still waiting, and they're still waiting. And then eventually, a lot of them get frustrated, right? And then you finally get a little dip in the market, and guess who's out there buying up, gobbling up shares? They are, right? Even though things are dramatically higher than if they just started buying 6 months ago, 3 months ago, 9 months ago. So this is what happens, okay? This is what happens, folks. This is what makes a market.
Opportunities to get into this market. We're not buying into this momentum-driven rally that we've seen.
If that's the case, if there is a serious pullback coming, I mean, how big of a pullback? You think this gets you back to what you could have bought at the beginning of May? What it gets you back to the beginning of March? What it gets you back to the beginning of January? How big of a pullback are you?
That's why I love you, Becky Quick. That's why I freaking love you. There's a reason Warren Buffett always has Becky Quick interview him, okay? Thank you, Becky Quick. Just put her in her place. There's a lot of people just wouldn't even understand what just even happened here.
Looking for.
Well, we think we could get some, between a 10 and 15% correction from here. And that's taking into the consideration that we think the PE multiples have gotten way too stretched here. The earnings expectations for 2024, we think are too stretched given our expectation for what the economy is going to look like. So we think we could get at least 10, 15% correction from here.
Yeah, so in terms of recession, right, it's always a chance, especially if the longer the Fed keeps rates high. I'm going to keep saying this over and over again until it's in everybody's heads. The longer the Fed keeps rates in an elevated place, the more chance of a actual serious recession goes up. It's as simple as that. And so if the Fed wants to keep, CPI is in the 2s, and we want to keep rates high, and we're going to keep rates high for longer and longer and longer, they can certainly do that. It's up to them. But I'm just telling you, like, the longer you do that for, the more of a risk of a serious recession creeps up on you. And then eventually things start breaking. Next thing you know, you got dominoes going the wrong way. Next thing you know, the Fed's starting to cut rates to zero. It's already too late by that time, right? You already have things collapsing left and right. And next thing you know, the money printers come out again. We need to save the whole system, and then we got to spend $1 trillion here, and it's called the Save America package, and we're going to spend $1.8 trillion on the American economy to save all these industries and save everything because everything's crashing. Like, yeah, no, it is what it is. We'll see, and that's why I'm going to remain hedged this year, and I will hedge for next year as well, because there's definitely a decent probability that the Fed could go too far. They've done it before. They won't do it again. Next up, Josh Brown responds to parabolic reversal in DHI post earnings. This should be interesting. By the way, Josh Brown, oh my gosh, I don't know if you guys know this, okay? He came out, this was such bad timing. Okay? Man came out like 2 or 3 days ago, spoke about Toast stock and why he just bought a bunch of Toast stock, okay? Literally the next day, Toast stock gets toasted. I mean, it was down like, 15+%, I think. It was such bad timing, man. And sometimes, oh gosh. And I remember this, of CNBC like clips, I think it got the most views that particular day it came out. And I mean, the poor guy just got absolutely toasted on this stock called Toast. And I'm like, what flipping flapjack and timing? Like, literally, he comes out on this day and announces, oh, I just bought a bunch of shares, and like CNBC put the clip up. It got a lot of views and whatnot. And literally today it's $21. Like, that's sometimes that happens in the stock market, man. You're like, oh, I'm so happy about this stock. I'm buying it. Next thing you know, it goes down 20%. You're like, what happened?
Well, first of all, Blackstone is up 47% year to date. And the market has understood that the private equity business, which is all about selling the companies that are in your portfolios, has been weak so far this year. And probably this was the lowest quarter for realization. And we're going to start to see an upturn because interest rates are peaking. And that's good for private equity. The fact that it's only down, I don't know, 1/4 point right now, I think is a positive because investors understand and they're looking past this quarter that's behind us to the future where realizations will pick up $1 trillion in assets.
Look at that year-to-date move. And I know a lot of bears out there have been betting against this one this year, and they were betting against it, especially the first few months of the year, thinking this was going to be the next domino to fall. And it's just held up really, really dang well. Maybe they played their cards too early. Maybe it's like a 2024 story. But nonetheless, Blackstone's been putting it together.
Their umbrella is incredible. They are the big gorilla in the room. And we really feel that with real estate starting to look positive and with them positioned in private equity and a number of funds that are doing.
Wait a minute. Hold your horses for just one moment. I don't know about this whole real estate starting to look great thing or good or whatever term she just used to describe real estate. I don't know about all that, okay? The bottom line is real estate, I don't think it's out of the woods. That's like saying the economy is going to be safe and, we're all... At the end of the day, I don't know if you guys have seen 30-year mortgage rates are pretty much about the highest they've been in decades right now, literally. Commercial real estate looks like a ticking time bomb, especially if we ever go into recession. So I don't know what she's talking about, okay? And we do know if there is any sort of significant recession, we do know that a lot of like the strip malls in that small commercial space, a lot of that dries up. So, and with interest rates being where interest rates are at right now, no. Okay, real estate is, in my opinion, still very questionable at this point in time.
Extremely well and growing with management fees and now selling.
As somebody that has millions of dollars invested in real estate, I can tell you it's still very iffy. I mean, very iffy.
Those assets. This is a stock, given that the multiple is below the market, will continue to outperform.
I think one of the...
I was thinking about buying another real estate investment property at the end of this year. I don't think I'm going to do it. I think I'll probably wait to 2024. That's what I'll say about that.
Interesting charts in the entire market today is D.R. Horton.
Sometimes you really need to move with urgency, and you got to really snap up assets. For instance, Q4 of 2022, big tech stocks, anything tech related, just better snap them up. It was a tremendous opportunity. Real estate, I'm kind of looking at it. I'm like, I could buy something at the end of this year, but I'm just looking and I'm like, I don't actually need to rush into any sort of move in regards to real estate at all right now, at all.
which I'm looking at right now. Look at the intraday there. You had a spike of like 4%, and then before you looked at it again, the stock is down more than 3%. I just want the take. Josh, you have a take here. I know you don't own it, but you do own Invitation. There's some other housing-related plays, and many of these stocks have been trading at all-time highs, and perhaps that is the only reason why we're seeing a chart look the way it does. Just the stocks have been ripping.
Yeah, I can't find like an actual reason. This is when people use the term blow off top, this is exactly what they're referring to. I don't like when stocks go parabolic and then reverse and close out the day negative. That's really dangerous price action. What we're doing here is analyzing the behavior of the buyers and sellers, not the fundamentals. And what that tells you is that maybe not a full-on psychological shift, but maybe the shareholder base is now too heavily concentrated amongst momentum players and maybe not as heavily concentrated amongst fundamentally driven shareholders as maybe it was 6 months ago. So when you get a lot of momentum money in a name, you could have a blow off top like this, a reversal like this. I think you got to be careful until it cools off.
Yeah. Horton,
I would have like knee jerk be buying into this.
Yeah, I mean,
here,
it's up 38%. It's up 38% year to date. XHB's up 36. Airlines are a place to look as well because of United Airlines, Jimmy. You own Alaska and Delta, as we talked yesterday.
Yeah, so
this sector's on
something
fire.
Definitely.
It's on fire. I mean, American also had good.
Okay. So something fishy is definitely going on with the home builders. You saw that move there, okay? Let me tell you something else fishy I saw. I've been looking because obviously I'm trying to figure out where I'm going to hedge at for 2024. One of the things I'm considering is home builders, one of many potential hedges for 2024, right? So I'm just keeping an eye on everything going on in the options market and whatnot. And I was looking at puts on some of the home builders, and man, you gotta pay up. You gotta pay up. So what that tells me is there's a lot of folks that are not really believing what's going on with the home builders is lasting, and that these ones will eventually get hit in 2024. That's what that's telling me. So I think the home builders are very intriguing to watch. I have a watch list just to home builders and home builder related stocks. Very intriguing to see kind of what's going on there. But yeah, home building has been hot strictly for the reason of just very low inventories. At some point, things will shift there, and they will shift in a major way. I appreciate everybody joining me as always. Thanks so much for being subscribed, folks. Continue to take advantage of deals out there that you see. There's plenty of them. I'll be taking advantage of deals out there tomorrow. Continue to build up the portfolio. If you want to support my content, you enjoy my channel and you enjoy my videos, then check out the pinned comment down there. That'll be to join my Patreon. It's $19. You get to see the moves I'm making out there in the market, plus be part of that Discord chat. Much love and have a great day.